Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the supply chain software sector, analyzing the core conflict between Descartes Systems Group, trading under the ticker DSGX, and Manhattan Associates, trading under the ticker MANH. These sectors bifurcating between Descartes, which functions as a defensive utility for global trade connectivity, and Manhattan Associates, which acts as a growth platform for complex enterprise fulfillment. Success is determined by the ability to balance stable, transaction-based recurring revenue against the execution risks inherent in scaling AI-native cloud platforms.
Yeah, it really is a profound divide, I mean, we are looking at two completely different philosophies on how to build, how to scale, and really how to monetize the infrastructure that just keeps the physical world moving.
Right. And before we get into the financial mechanics of those philosophies, I want you to picture a scenario.
Okay, lay it out.
So imagine a massive, 300-meter-long cargo ship floating just off the coast of Rotterdam.
I can picture it.
Right. And it is loaded with over $100 million worth of electronics, pharmaceuticals, automotive parts. The engines are idling. The crew is waiting, but that ship cannot dock.
That's not because of a storm.
Right, exactly. Not a storm, not a strike. It cannot dock because a single digital customs document formulated on some server halfway across the world is missing a critical string of compliance code.
Wow.
Yeah, and every hour that ship sits there, supply chains ripple. Factory floors in Germany pause. And retail shelves in Chicago just remain empty.
It's crazy how fragile it is.
It really is.
Yeah.
The stakes here aren't just, software glitches. We are talking about the potential paralysis of the global economy.
And that is exactly the scale we are dealing with today. Supply chain software is, well, it's the invisible architecture of literally everything we consume.
Which is wild to think about.
It is. And to build a really precise mental model of who controls that architecture, we have pulled together a pretty fascinating stack of sources for this deep dive.
Yeah, we have a lot to get through.
We do. We are dissecting the Q1 2026 and Q1 2027 earnings transcripts for both Descartes and Manhattan Associates to get the raw, unfiltered accounting math.
Which is where the real story is.
Always. We are also pulling from this phenomenal equity research note from William Blair on software sentiment and what they call the interface tax.
That part is super interesting. We'll definitely get into that later.
Oh, absolutely. And finally, we are diving into some highly technical architectural white papers on agentic AI and how it physically manifests in a warehouse environment.
So our mission today is to equip you with that mental model, because these two premium mid-cap enterprise software giants are basically on a competitive collision course.
They really are.
Historically, they kind of played in their own little corners of the sandbox, right?
Yeah, completely separated.
Right. One handled the massive warehouses and the other handled the borders. But now, as they both aggressively expand their cloud and AI capabilities, they're just hurtling toward each other.
It is a battle for the ultimate end-to-end control of the enterprise supply chain.
Exactly.
Yeah.
But to understand where they are going, we have to audit where they are right now. We have to look under the hood at the mechanical variables defining their recent performance.
Because the stories these two companies tell investors are completely anchored in their margin structures and their revenue models.
You can't just listen to the marketing.
No, you really can't understand their AI strategies until you understand how their underlying accounting math actually drives their valuations today.
Okay, let's unpack this. Let's start with Descartes Systems Group, because their model is just fascinating from a pure accounting standpoint.
It's incredibly unique.
It is. They operate what you could call a high-margin utility model. And they do this primarily outside the four walls.
Right.
Now, I hear that phrase a lot in these industry reports, but let's define it for everyone. What does outside the four walls actually look like in practice?
That phrase is absolutely critical. When we talk about logistics outside the four walls, we are talking about the untamed physical movement of goods across the globe.
Like the really chaotic stuff.
Exactly. The oceans, the airspace, the highways, and most importantly, the international borders.
So where does Descartes fit into that chaos?
So Descartes operates something called the Global Logistics Network, or the GLN. And I want you to think of the GLN not just as a software application, but as a massive, completely capital-light digital nervous system.
A nervous system.
Yeah, it integrates highly fragmented data across millions of endpoints. We are talking about connecting shippers in Shenzhen, airlines in Frankfurt, ocean carriers in the Pacific, trucking fleets in the American Midwest.
And all the different customs agencies, right?
Exactly, the customs authorities of virtually every developed nation.
It's like the ultimate digital translator. Because if you think about it, a manufacturer in Vietnam does not use the same software system as U.S. Customs and Border Protection.
Not even close.
Right. So when a cargo ship leaves for Los Angeles, there is an incredible amount of chaotic data-like bills of lading, hazardous material declarations, commercial invoices that just needs to be exchanged, verified, and translated perfectly.
It's a massive data problem.
And Descartes is the network handling those digital handshakes.
Yeah.
I like to think of them as the toll booth on the international highway.
Yeah.
Every single participant has to pay to cross.
It's an interesting analogy, but I would actually push back a bit on the traditional idea of a toll booth.
Oh, why is that?
Well, a toll booth implies a physical bottleneck that you could theoretically drive around if you found a back road.
I guess that's true.
Right, but with Descartes, the currency isn't just access. The currency is compliance data. You cannot drive around international customs law.
Oh, I see what you mean.
So it's a toll booth where the local government literally forces you to use it and forces you to pay the operator. And what's fascinating here is the financial math that this localized monopoly on compliance produces.
Because everyone is locked in.
Exactly. Because the GLN acts as this essential connectivity hub, it secures highly predictable recurring cash flows. Based on their latest reporting, an astonishing 93% of Descartes' total revenue comes from highly predictable recurring services.
Wait, I have to stop you there. 93% recurring revenue.
93%.
That is the dream scenario for any software executive. That means on January 1st, before their sales team even makes a single phone call, 93% of their target is already locked in by companies simply maintaining their access to the network.
Exactly. It completely de-risks their top line. And because they are operating this massive digital network, their business model is incredibly capital light.
Right, they aren't building physical stuff.
No, they aren't pouring concrete or building physical infrastructure. They are just maintaining server space and code. And that specific architecture supports an industry-leading 78% gross margin.
78%. Let's ground that number for a second because that is huge.
It's massive.
If they bring in $1 of revenue, it only costs them 22 cents to actually deliver the service. That leaves 78 cents to pay for R&D, sales, and eventually pure profit.
And that is where the power of their operating leverage becomes terrifyingly clear for their competitors.
How?
Well, once that core GLN infrastructure is built and the code is humming, the marginal cost of adding a new participant, say a mid-sized trucking fleet in Ohio that suddenly needs to ship parts to Toronto, is incredibly low.
Because the network is already there.
Right. The integration protocols are already written, so every new dollar of subscription revenue that comes through the door drops almost entirely to the bottom line. It is the purest definition of software scalability.
Okay, I see the defensive moat there. So that is Descartes. The outside the four walls, highly predictable, high-margin utility.
Exactly.
But let's pivot, because the other side of this barbell, Manhattan Associates, operates in a completely different reality. They operate inside the four walls. And to me, this sounds like a much messier, much more physical business.
Oh, it is infinitely more physical. Manhattan Associates is historically the gold standard for execution inside the massive, hyper-automated distribution centers of Fortune 500 retailers.
So we aren't talking about, like, a backroom storage closet.
No, not at all. If a retail giant has a warehouse the size of 15 football fields, towering with multi-level storage, swarming with robotic retrieval systems, miles of conveyor belts.
It's like a massive operation.
Yeah, and thousands of human workers picking and packing tens of thousands of individual orders an hour. Manhattan Associates is the centralized software brain running that entire operation.
Wow.
They unify the warehouse management system, the transportation execution, and the point-of-sale systems into one seamless flow.
But despite being the gold standard, Manhattan's going through a massive structural transition right now, aren't they?
They are. It's a really critical period for them.
Yeah. The sources show they are aggressively moving away from the old way of selling software, like the legacy licensing model.
It's the old perpetual licenses, yeah.
Right. This is where a massive retailer pays a huge upfront fee, millions of dollars, to install the software directly onto their own physical servers sitting in their own IT basement.
Which is how everyone used to do it.
But Manhattan is moving away from that, pushing everyone toward a cloud-native, recurring subscription model. And the accounting numbers on this transition look incredibly violent.
Violent is definitely the right word for it.
I mean, legacy licensing plummeted 76.3%, down to a mere $2.2 million in their Q1 2026 reporting. That's a huge drop.
It is, and it is always a painful white-knuckle transition for a publicly traded company to manage. They are effectively starving their old, highly lucrative cash cow to force their customer base into the cloud.
Which is super risky.
Very risky. Historically, we've seen companies like Adobe and Microsoft manage this transition successfully, but many others have failed because the market punishes them for the sudden drop in upfront cash.
Right. If I'm an investor skimming a quarterly earnings sheet and I see a 76% drop in a revenue category, my first instinct is to hit the panic button. So how is Manhattan justifying this to the market?
They justify it because the long-term upside of the cloud is exponentially higher, and we are actually seeing that upside materialize right now.
Oh, the cloud numbers are good.
Very good. Cloud subscription revenue surged 24.2% year over year to $117.1 million in that exact same quarter.
Okay, that makes up for it.
Yeah, they are replacing one-time lumpy cash influxes with highly reliable compounding subscription revenue.
And it's not just top-line revenue growth either. It's actually driving operational profitability. Because of that cloud growth, they revised their adjusted operating margin target upward to 35%.
Which is just a staggering achievement.
Really?
Oh, absolutely. Achieving a 35% operating margin while undergoing a fundamental platform rewrite, while heavily investing in cloud server infrastructure, and while retraining your entire sales force to sell subscriptions instead of perpetual licenses.
That's a lot to juggle.
It is a massive testament to their pricing power. It proves that their software is not discretionary. The world's largest retailers simply cannot run their operations without it, so they are willing to accept the new cloud pricing model.
Okay, so let's check our mental model here. We have Descartes, the borderless digital network, taxing every piece of compliance data that moves globally, generating a 78% gross margin.
Yep.
And we have Manhattan, the architects of the hyper-complex, robotic mega warehouses, pushing through a massive cloud transition to hit a 35% operating margin.
That's the landscape.
That brings us to a major question. Margins and theoretical business models look great on an Excel spreadsheet. But how do these operational models actually survive contact with reality?
That is the big question right now.
Because right now we are dealing with serious macroeconomic headwinds, volatile inflation, and highly unpredictable global e-commerce volumes. How does this theoretical performance actually convert into real-world revenue?
That is the crucial pivot we need to make here. We have to look at their backlog and analyze what we are calling the conversion paradox.
The conversion paradox, I like that.
Right, because having a beautiful margin structure on paper is entirely useless if you cannot close deals when corporate budgets tighten. Let's look at Descartes first, because their latest numbers suggest they are practically immune to current macro volatility.
Immune, that's a strong word.
It is, but look at the data. They just reported record Q1 FY2027 growth. They hit $193.6 million in revenue, which is a 15% year-over-year increase.
Wow.
And it wasn't just revenue. Their net income didn't just inch up. It exploded, rising 34% to $48.5 million.
A 15% revenue jump and a 34% net income jump in this economy. I really need you to explain that.
It's pretty incredible.
If consumer spending is softening and companies are shipping fewer televisions and sneakers across the ocean, shouldn't Descartes' transaction volume be dropping? How are they so insulated?
If we connect this to the bigger picture, the answer lies entirely in their core operational moat: mandatory trade compliance.
Mandatory, meaning they have no choice.
Exactly. Let's go back to our ship sitting off the coast of Rotterdam. Filing customs paperwork across borders is not a nice-to-have optimization feature.
Right. It's not a luxury.
No, it is not an analytics dashboard that a supply chain manager can simply cancel to save money this quarter. It is legally mandated by sovereign governments.
It's literally a tax on existence for a shipping company.
Precisely. If you want to move goods from Asia into the European Union, you have to comply with incredibly complex, constantly evolving customs regulations.
Are there any specific new regulations driving this?
Oh, constantly. Like the EU's new ICS2 mandate, which fundamentally changed how security and safety data is processed for imported goods, or the UK's Customs Declaration Service, the CDS.
So you can't just ignore these.
You absolutely cannot bypass these systems. If the paperwork isn't formatted perfectly, translated accurately, and filed digitally through an approved network like Descartes, your shipping container does not move.
It just gets stuck.
It sits at the port, accumulating accumulating massive demurrage fees until you fix it.
So even if overall global shipping volumes dip slightly because a recession hits, the companies moving those goods still have to pay the utility bill to Descartes to process the compliance data for whatever goods actually are moving.
Exactly. The volume might dip, but the compliance requirement never goes away.
And furthermore, if the regulations get more complex, say, the EU adds 3 new layers of environmental reporting. Descartes can charge more for the increased data processing, right?
That's the beauty of their model. It is a required operating expense completely divorced from discretionary corporate IT budgets.
That is the ultimate defensive moat. Now, contrast that smooth, legally mandated revenue stream with Manhattan's execution tests.
It's a very different picture over there.
Right. Manhattan's Q1 2026 performance was also incredibly strong, but it relies on a very different dynamic. They hit $282.2 million in total revenue, and they felt confident enough to raise their full-year outlook to over $1.14 billion.
Huge numbers.
But the most important metric they reported is their remaining performance obligations, or RPO, which stands at a massive $2.35 billion.
Yes, the RPO is the key metric to watch here.
For our listeners who might not be deep into SaaS accounting, let's define RPO real quick. It's basically the backlog, right?
Yeah, that's exactly what it is.
It represents the total value of contracted revenue that a company has secured, but hasn't yet recognized on the income statement because the service hasn't been fully delivered yet.
You've got it.
So a $2.35 billion RPO, which their transcript notes is growing at 24% year over year, shows that the demand for Manhattan's cloud platform is just massive. Companies are signing massive contracts.
The demand is definitely robust. But here is the conversion paradox we mentioned earlier.
So it's here.
Manhattan relies on selling these massive high-volume operations. These are not simple software downloads where you just, enter a credit card, provision a server, and you're running by Tuesday.
That's why not.
No, these are comprehensive, multi-million-dollar, multi-year transformations of an enterprise's entire physical fulfillment network. And that structural reality creates incredibly lumpy deal cycles.
I was actually reading the transcript, and Manhattan CFO Linda Pinn was very explicit about this. She specifically noted that their bookings can be non-linear. What does that mean in human terms?
What's fascinating here is the sheer scale of the sales motion.
Right.
When Manhattan is selling a comprehensive application deal, meaning they're convincing a top-tier global retailer to rip out their old systems and use Manhattan for both distribution center management and omnichannel logistics, that is a monstrous, complex sale.
It's not a quick pitch.
No, it involves the retailer's CEO, the CFO, the chief supply chain officer, and the head of IT. It takes many months, sometimes years, to negotiate.
Wow, years.
Yeah, and when it finally closes, it creates a massive spike in bookings for that specific quarter. But those spikes are inherently unpredictable.
Because you can't time it perfectly.
Exactly. You cannot guarantee that a $15 million deal will sign in Q1 rather than slipping into Q2 because the retailer's legal team needed an extra 3 weeks to review the liability clauses.
And it's not just the unpredictability of the sales cycle, it's the physical friction of the actual implementation.
Yeah, that's the other half of the paradox.
To install these massive cloud platforms, Manhattan relies heavily on human capital. They can't just flip a switch. They have to send in teams of highly trained professional services personnel to meticulously map the software to the chaotic physical reality of the warehouse.
Exactly. The software does not run itself on day one. It requires significant, high-touch professional services to deploy. And this creates their most significant near-term execution test.
Balancing the workforce.
Yes. Manhattan has to carefully balance their internal services capacity, meaning the number of implementation engineers and domain experts they have on payroll with the velocity of their incoming deals.
Here's where it gets really interesting and a little dangerous.
Oh, yeah.
If Manhattan requires all this heavy lifting and all this highly paid human capital to install their software, what happens when a macro shock hits?
That's the billion-dollar question.
Right. If inflation spikes again and a major retail client says, you know what, consumer spending is plummeting. Let's pause this $20 million warehouse automation upgrade until next year. What happens to Manhattan? Do they just eat the cost of all those engineers sitting around with nothing to do?
That is the exact vulnerability analysts point to when they label Manhattan a higher beta play compared to Descartes.
It's a lot riskier.
It is. A delayed deal directly compresses their margins because they are still paying the salaries of the implementation teams.
So how do they mitigate that?
Manhattan's mitigation strategy against this relies on 2 pillars. First, extremely conservative forecasting.
They don't overpromise.
Exactly. Even after blowing past expectations with a massive Q1 beat, management kept their guidance for the rest of the year relatively guarded. They explicitly cited limited clarity from external macro variables. They aren't assuming the good times will roll uninterrupted.
Smart.
And second, they rely heavily on that RPO backlog. That $2.35 billion in contracted future revenue acts as a massive shock absorber.
Ah, I see.
Even if new bookings slow down temporarily because of an economic scare, Manhattan has a mountain of existing, contracted work to execute and bill against to keep their teams busy.
It's a high-wire act. You have to perfectly calibrate the hiring of your engineers to the exact moment a client is ready to rip out their old server racks. But so far, the numbers suggest they are executing it beautifully.
They really are.
Now, all of this heavy lifting, this transition to the cloud, this massive hiring, it all sets the stage for the absolute bleeding edge of this deep dive.
Here we go.
We are entering the forensic audit of artificial intelligence monetization. Because right now, AI is the ultimate, undeniable growth driver for both of these companies.
It's what everyone is talking about.
But their strategies for how to build it, how to scale it, and how to actually squeeze money out of it are philosophically opposed.
They are entirely divergent, and this divergence really acts as a mirror, reflecting the core difference in their corporate DNA.
Let's look closely at Manhattan's strategy first, because it is incredibly ambitious.
It really is. They are focused on the organic internal development of what they call active agents.
I have to admit, digging into the technical papers on Manhattan's agentic AI completely changed my perspective on what enterprise software can do.
It's next-level stuff.
They aren't just slapping a generative text chatbot onto their existing dashboard and writing "powered by AI" on their marketing material.
Yeah, it's not just a wrapper.
Right. They are engineering autonomous reasoning agents designed to actively orchestrate physical fulfillment and maximize labor efficiency.
Let's give an example of that.
Okay, we're talking about an AI that can ingest millions of data points across a massive warehouse, see that a physical bottleneck is starting to form on outbound conveyor belt 3, realize that a delivery truck is going to miss its departure window, and then autonomously reroute robotic pickers and human floor workers to clear the jam all before a human floor manager even realizes there's a problem.
It is a massive leap from reactive analytics to proactive autonomous orchestration.
It's like having a supercomputer manager.
Exactly, but the underlying philosophy of how they deploy this is what really matters for investors. Manhattan CEO Eric Clark made a statement during the earnings call that I think perfectly encapsulates the future of enterprise software economics.
What do you say?
He said that SaaS platforms will act to control the cost of intelligence.
Control the cost of intelligence. Let's really break that down for you, the listener, because that sounds like a tech buzzword, but there is a brutal financial reality behind it, isn't there?
There absolutely is. The idea is that modern AI, specifically generative AI, large language models, and complex reasoning algorithms, is computationally exorbitant.
It's insanely expensive to run.
Very. Running probabilistic AI requires massive GPU power. It consumes vast amounts of energy and server capacity. On the other hand, traditional cloud SaaS handles deterministic tasks incredibly cheaply on standard CPUs.
Okay, to make sure we're on the same page, a deterministic task is something simple and binary. If you just need the software to remember that ski number 123, let's say it's a box of AA batteries, is located in aisle 4, bin B, you do not need a massive, power-hungry neural network for that. A basic, incredibly cheap database query does the job perfectly every single time.
Exactly. And Manhattan knows this, so their architectural strategy is to use their robust cloud-native SaaS platform to handle all of those cheap deterministic tasks.
They let the cheap software do the easy work.
Right. They use the platform as the foundational governor, and they only inject the expensive probabilistic AI compute into the workflow where it adds highly measurable, high-impact value.
Like what?
Like predicting the absolute optimal path for a human picker to walk to save 3 minutes of transit time. The SaaS platform controls and optimizes the massive computing costs associated with the AI.
That makes total sense.
They aren't replacing their entire software stack with AI. They are utilizing their software architecture to make AI economically viable for their customers.
That is brilliant margin protection. But we need to do a strict audit of the timeline here because AI hype is everywhere.
Oh, it's unavoidable right now.
Every company says AI will revolutionize their industry. But we want to see the actual financial conversion. How close is Manhattan to actually charging money for this?
Closer than you might think.
The sources indicate they are currently running 90-day paid AI pilots with a select group of major clients. And the tangible results they are reporting aren't just theoretical, they are staggering.
The pilot numbers are incredible.
They are seeing what they call triage exceptions, which are basically operational errors, missing inventory, or system anomalies that usually require a human manager to stop what they're doing and investigate reduced by up to 75%.
Let's linger on that metric for a second. A 75% reduction in triage exceptions.
That's massive.
In a massive enterprise facility, triage exceptions are the primary cause of labor bloat. When something goes wrong, human labor literally stops, and managers spend hours hunting down the discrepancy.
It's burning cash.
Exactly. If an autonomous agent can instantly cross-reference the data, identify the missing inventory, and resolve the exception without human intervention 75% of the time, that is a massive reduction in wasted labor hours.
I can't even imagine the cost savings.
And furthermore, they reported that these pilots are showing increased shipped lines, which is the actual volume of physical goods moving out the doors and onto trucks, by over 30%.
30% more throughput without having to expand the physical footprint of the warehouse, or hire 30% more staff.
It's pure efficiency.
If you can walk into the boardroom of a Fortune 500 retailer and prove that your activations can achieve that, that is essentially a blank check value proposition.
Absolutely.
But what surprised me was the restraint in how Manhattan is talking about the money. Despite these incredible pilot numbers, management has been remarkably disciplined in managing investor expectations.
They really have been.
They have firmly stated that AI monetization is a 2027 financial driver. They are explicitly not treating it as a near-term 2026 revenue engine.
That discipline is critical. They are taking the time to prove the model, stress test the agents in live, chaotic environments, and figure out the exact pricing mechanics before they force it on their broader customer base. They are building a proprietary foundation.
Okay, so that is Manhattan. Building complex, autonomous AI agents natively from the ground up to orchestrate physical labor. Now, let's pivot and look at Descartes, because their approach to artificial intelligence could not be more different.
It is entirely different. Descartes utilizes a strictly acquisitive AI strategy.
Meaning they buy it, they don't build it.
Exactly. They do not have massive teams of internal engineers trying to build the next great foundational model or autonomous routing agent from scratch. Instead, they let the broader venture capital market take all the R&D risk.
That's a clever way to do it.
It is. They sit back, watch the ecosystem, wait to see which AI startups actually survive, build a working product, and prove their value in the real world. And then, utilizing their massive, predictable cash flow, they simply step in and acquire them.
It's ruthless, but it's brilliant in its simplicity. Let's look at the tangible value here. The sources highlight two specific recent acquisitions by Descartes: OrderMine and Idyllic.
Two very strategic buys.
They bought these advanced AI-driven safety and route optimization tools, and they essentially just bolted them onto their existing global logistics network.
And notice the fundamental difference in what they are actually selling to the end user.
Right.
Manhattan is selling operational throughput and physical execution to warehouse managers. Descartes is selling productivity efficiency to back-office IT and compliance departments.
That's a huge distinction.
It is. They are using their acquired AI to automate the incredibly tedious data entry, the complex cross-border route planning, the regulatory safety compliance checks.
Yeah.
It is purely an information play, not a physical execution play.
Wait, I need to push back on this, because here is where the build versus buy dynamic gets really precarious.
Okay, let's hear the pushback.
Isn't Descartes taking a huge risk by just bolting on disparate software? By buying all these different startups, aren't they going to end up with a fragmented Frankenstein suite of software that doesn't actually talk to itself efficiently?
That is the classic risk of M&A, yes.
Meanwhile, Manhattan is taking on massive internal R&D risk, sure, but they are building a unified native brain. Doesn't Manhattan's approach create a far superior product in the long run?
This raises an important question about the nature of competitive advantage in the AI era. Yes, Descartes risks in integration friction, but their acquisitive model protects their pristine 78% gross margins and avoids heavy speculative engineering investments that might lead nowhere.
So it's financially safer.
Exactly. They buy guaranteed revenue and proven tech. However, Manhattan's leadership has vehemently argued that true durable advantage in the age of AI comes from deep proprietary architecture.
Because it's built to work together from day one.
Right. By building the AI natively into the very fabric of their microservices platform from day one, Manhattan is creating a unified system that an acquired, bolted-on product can never truly replicate. Manhattan is betting that the deepest, most native integration yields the highest operational performance and therefore the greatest pricing power.
It's the ultimate philosophical divide. Do you want to be the aggregator of proven tools, or do you want to be the architect of the ultimate machine?
Perfectly stated.
And this difference buying AI versus building AI internally directly dictates how these two giants manage their balance sheets. How do they actually deploy their capital?
Capital allocation is the purest, most honest reflection of a management team's true priorities. You can ignore the marketing brochures, just look at how they spend their free cash flow.
Always follow the money.
Exactly. And Descartes' strategy perfectly mirrors their operational model. They operate a fiercely debt-light utility model. Because their global logistics network is capital light and generates massive, highly predictable recurring cash flow, they have built a veritable fortress balance sheet.
And they use that strong, continuous liquidity to fund those specific high accretion acquisitions we just talked about.
They don't need to borrow for it.
Right. They aren't going to Wall Street and taking on massive debt loads to fund huge transformative mergers that might bloat up in their faces. They are making highly disciplined, tactical, bolt-on acquisitions purely out of their cash flow.
Exactly. And simultaneously, they're heavily returning capital to their shareholders.
Which investors love.
Oh, of course. The sources specifically highlight their recent share repurchase execution. As part of their capital return strategy, Descartes executed a $35 million repurchase program.
Let's think about the signal that sends.
It's a very strong signal.
When a company is aggressively funding acquisitions, expanding their network, and buying back $35 million of their own stock, all purely out of free cash flow, without leveraging up the balance sheet with toxic debt, that signals an incredible level of structural financial power.
It's the ultimate flex. It basically says, we have so much cash, we can buy our competitors and buy our own stock at the same time.
Exactly. Now let's contrast that fortress model with Manhattan's growth scalar model.
Yeah.
Manhattan's taking a wildly different path with its capital.
Completely different.
They are funneling massive amounts of money into deep internal R&D and intense human capital expansion. Just look at the Q1 2026 numbers. They added roughly 120 headcount to their professional services division in a single quarter, and they explicitly noted that they have 70 more open roles pending.
That level of rapid hiring is a massive operational commitment. It shows the sheer human effort required to physically deploy their cloud platform and integrate these complex new active agents into highly customized client environments.
They can afford it, right?
Oh, absolutely. Despite these heavy growth-oriented investments and despite carrying the cost of all those new engineers, Manhattan's financial strength remains formidable. They ended the quarter with zero debt and $226 million in cash on hand.
Zero debt, while successfully forcing a platform transition away from legacy licensing and aggressively expanding headcount. That is wild.
It shows incredible execution.
And just like Descartes, Manhattan is sending a massive, unmistakable signal of management confidence to the market regarding their stock. They recently announced a staggering $500 million share repurchase authorization.
If we connect this to the bigger picture, both of these companies are aggressively returning capital to shareholders, which tells you they both operate highly attractive, cash-generative business models.
But their bets are different.
Exactly. Their fundamental bets on how to dominate the future are completely different. Descartes is betting on the network effect of consolidated capital.
The aggregator model.
Right. They believe that by using their cash to constantly consolidate the fragmented logistics market, buying up smaller, specialized tools and plugging them into their global utility network, they become an unstoppable, comprehensive monopoly on data.
And
Manhattan, on the other hand, is betting on proprietary depth. They are using their cash to fund the organic architecture of the future warehouse, betting that absolute technical superiority will win the enterprise market.
So we've looked at how they build their technology, and we've audited how they deploy their capital. But to truly understand their vulnerabilities, we have to look at where they operate in the physical world.
Geography is huge here.
Capital strategy determines how a company grows, but their geographical footprints determine where their moats are impenetrable and where they might be suddenly exposed to geopolitical shocks.
Right, because geography in the context of supply chain software isn't just about where your corporate offices are located, it's about where your data flows, where your physical integrations are required, and where your operational impact is concentrated.
Let's map out Descartes' footprint first, because it is truly a borderless moat. Descartes operates across an astounding 160 countries.
160 countries is basically everywhere.
It is. To manage this massive sprawl, they employ a highly decentralized regional autonomy model, breaking their operations down into the Americas, EMEA, and APAC.
And they have to do it that way.
Right. And the reason they need that high degree of regional autonomy is that they have to handle deeply localized, hyper-specific customs integrations.
Yes, customs compliance is inherently hyperlocal and fiercely protected by sovereign states.
Everyone has their own rules.
Exactly. The specific digital syntax the EU requires for the ICS2 mandate is entirely different from how the UK demands data for the CDS system, which is entirely different from how the United States processes inbound ocean freight.
So Descartes cannot just write one generic piece of code.
They absolutely cannot. They have to possess deep, localized, hard-won expertise in all 160 of those countries to ensure the data flows seamlessly through those specific governmental gateways.
And here is the defensive genius of that incredibly broad 160 country net. It provides a massive built-in hedge against localized trade volatility.
Let's give an example.
I want to paint a scenario here. Let's say a sudden geopolitical conflict erupts, or a brutal trade war shuts down a major high-volume shipping route. Let's say the Strait of Malacca is suddenly closed to commercial traffic.
That would be a massive shock.
If you are a niche logistics software company solely focused on optimizing that specific route, your revenue goes to zero overnight. You are devastated.
You're out of business.
But for Descartes, the global demand for those physical goods doesn't just disappear. The supply chain simply reroutes itself. The cargo ships sail from a different origin country, they take a massive detour around the Cape of Good Hope, and they enter a completely different port.
And Descartes is already there waiting for them.
Exactly. Because Descartes is already deeply integrated into the customs authorities of those alternate ports across 160 countries, they just capture the compliance data flow on the new route. The broader network absorbs the geopolitical shock without missing a beat.
That is the essence of a network-centric footprint. The wider the net, the less you care about the specific path the fish takes.
I love that analogy.
Now compare that broad defensive strategy to Manhattan's approach. Manhattan does not need to be everywhere.
They aren't trying to be in 160 countries.
No, they don't care about having deep customs integration in 160 countries. They need to be exactly where the massive volume of physical goods actually terminates.
Where the big buildings are.
Right. They have deep, intense concentration in high-complexity, enterprise-grade markets. Primarily, this means North America, Europe, and the major retail distribution hubs in the Asia-Pacific region.
They provide essential, incredibly high-touch fulfillment services for the absolute largest retailers in the world. Their moat isn't geographic breadth across hundreds of borders. It's operational depth within specific, massive buildings.
It's what the sources refer to as the 80% applied domain knowledge of complex warehouse edge cases.
Let's unpack what applied domain knowledge really means in reality, because this is the exact reason why Manhattan's enterprise customers cannot easily rip them out and switch to a cheaper, generic competitor or a basic AI startup.
It's a huge barrier to entry.
Imagine a very real scenario in a massive distribution center. A tractor-trailer arrives at the receiving dock, and the digital advance ship notice, the data feed, says it contains exactly 1,000 units of a high-value electronic device, let's say the latest smartphone.
Okay, 1,000 phones expected.
But when the warehouse workers actually open the trailer and unload the pallets, they physically count only 997 units. And to make matters worse, 14 of those units are physically crushed because a forklift punctured the box.
Okay, so you have a partial receipt with damaged goods. On paper, it seems like a simple math problem. Subtract 3 missing, subtract 14 damaged.
Right, but it's not a math problem.
No, it's not a math problem. It's a massive cascading operational crisis because the central software system has to immediately, in real time, answer a dozen complex questions to prevent the rest of the warehouse from freezing.
What kind of questions?
Well, first, do we allocate the surviving pristine inventory to fulfilling pending direct-to-consumer online orders, or do we prioritize sending them to our flagship retail stores to restock shelves?
Prioritization.
Right? How does this sudden drop in expected inventory impact our automated replenishment triggers with the overseas manufacturer? How do we instantly value the 14 damaged units for internal accounting and insurance purposes?
It just ripples through the whole system.
It does. Do we trigger an immediate localized cycle count for the specific storage aisle where these phones were supposed to be slotted to ensure the physical space matches the digital record?
Wow. Yeah, when you put it like that, an off-the-shelf software program or a generic large language model cannot just guess the right answers to those highly specific, highly consequential questions.
Absolutely not. A wrong guess means missed sales or massive accounting errors. Manhattan has spent the last 30 years learning the exact answers to those chaotic edge cases across thousands of live, high-pressure warehouse environments.
They've seen it all before.
Exactly. They have codified that hard-won operational reality directly into their core software architecture. That profound depth of applied knowledge is their true geographic moat. They own the complex physical reality of the enterprise distribution center.
So what does this all mean for you, the listener? If you are analyzing this sector, if you are looking at these companies as a potential investment, or if you are an IT executive choosing a strategic partner, you have to ask yourself a fundamental question about the future of commerce.
What's the question?
Do you want the company that acts as an unavoidable utility, profiting a little bit every single time a piece of data crosses any border in the world, no matter where it goes or how it gets there?
The Descartes model.
Right. Or do you want the company that engineers the massive, complex robotic hubs where all of those physical items inevitably end up?
It is the ultimate supply chain barbell strategy. And that brings us perfectly to our synthesis. We have audited the gross margins, we have scrutinized the divergent AI roadmaps, we have analyzed their massive share repurchases, and we have mapped their geographical moats.
It is time to deliver the final verdict.
I think so.
I've challenged the models, but I want to hear your final read. Lay out the synthesis for us. Which side of the barbell wins?
Well, it depends entirely on your risk tolerance and your view of the macro environment.
Break it down for us.
For the long-term, highly conservative approach, Descartes' defensive connectivity model is the ultimate utility play.
For the cautious investor.
Exactly. If you value incredibly high-margin, highly predictable recurring revenue that is literally legally mandated by sovereign global trade compliance laws, Descartes offers a structurally insulated, debt-free growth engine.
It's hard to beat that stability.
It is. Their strict acquisitive strategy limits internal R&D risk, and their broad 160-country geographic net severely limits their exposure to localized geopolitical volatility. They are the safe harbor.
And for the growth-oriented side of the barbell, the investors who want to capture the AI upside.
For the growth-oriented approach, Manhattan's growth platform represents a higher beta play with absolutely massive potential upside.
Higher risk, higher reward.
Right. They are successfully managing a highly perilous transition to a highly profitable cloud-native model, aiming for 35% margins. And they are the undisputed pioneers in building the organic agentic AI required to truly automate the physical supply chains of the future.
So they are building the future.
Exactly. Their upside is deeply, inextricably tied to the ongoing digital and robotic transformation of the world's largest enterprises.
But I think we need to be very clear with our listeners.
Yeah.
Neither of these paths is without serious hurdles. Both companies are navigating incredibly complex transitions in a very fragile global economy.
No investment is perfect.
Exactly. Let's clearly outline the three primary execution risks that anyone following this space needs to monitor closely going forward. Let's start with risk number one, valuation compression.
Yes, valuation compression is the invisible gravity of the market. Both of these stocks trade at premium, elevated multiples in the high multiple software space.
Meaning they're expensive.
Simply put, they are priced for absolute perfection. Because they are widely recognized as premium, best-in-class assets, the market expects flawless execution quarter after quarter.
Which is hard to maintain.
Very hard. If broader macroeconomic sentiment cools on the software sector as a whole, perhaps due to rising interest rates, or if the initial euphoric hype cycle around artificial intelligence begins to normalize and investors demand faster ROI, both Descartes and Manhattan face severe multiple compression risks.
Even if the companies themselves are doing fine.
Exactly. Their underlying businesses could remain perfectly healthy, they could continue growing revenue, but the premium that investors are willing to pay for every dollar of those earnings could shrink dramatically.
Right. You can't outrun a sector-wide re-rating.
Yeah.
If the tide goes out on software multiples, even the best boats drop.
That's a great way to put it.
Okay, risk number 2. Macro-driven e-commerce volatility. Now, based on what we've discussed, this seems to disproportionately impact Manhattan.
Absolutely. This risk uniquely and acutely threatens Manhattan's operational model. As we discussed with the conversion paradox, Manhattan relies on closing massive, lumpy, multi-million-dollar deals.
The big whale hunting.
Exactly. Deploying a comprehensive enterprise warehouse management system is a massive capital expenditure for a retailer. It requires board-level approval.
So if the economy wobbles,
If global inflation remains sticky, if consumer discretionary spending drops significantly, or if global e-commerce volumes stall, those major Fortune 500 retailers may simply decide to pause, delay, or downsize those massive capital-intensive warehouse upgrades to preserve their own cash.
and that hurts Manhattan directly.
Yes. That macro-driven volatility in corporate capex could create sudden, brutal air pockets in Manhattan's revenue growth. Descartes, with its transaction-based, legally mandated utility model, is largely insulated from this specific macro shock.
A retailer can delay buying new robots, but they can't delay filing their customs paperwork. That makes sense.
Exactly.
And finally, risk number 3, services capacity risk. This brings us back to the human element of scaling cloud software.
Exactly. As Manhattan transitions to this highly advanced AI-driven cloud platform, there is a very real operational risk that their professional services capacity, the actual human engineers, architects, and implementation specialists needed to physically deploy the software in these massive warehouses, outpaces their actual billable velocity.
Because they hired all those people.
Remember, they are hiring aggressively, adding 120 headcount in a single quarter to support future growth. But if that deal flow slows down even slightly due to the macro volatility we just discussed, Manhattan could find themselves carrying a massive, heavy fixed cost of highly paid technical talent sitting idle on the bench.
And that crushes the margins.
That dynamic would immediately compress those beautiful 35% operating margins they're targeting.
It all comes back to execution. You can build the most advanced autonomous AI agents in the world, but if you can't install them efficiently and keep your deployment teams perfectly utilized, the margins just evaporate.
Precisely. The technology is only as good as the human logistics required to deploy it.
We have covered an immense amount of ground today, from the mechanics of cross-border customs data to the underlying computing cost of probabilistic artificial intelligence.
It's a lot to process.
It is. But before we sign off, I want to leave you with one final provocative concept to mull over on your own.
Oh, I'm curious where you're going with this.
Well, we've talked extensively today about how Manhattan is using AI to optimize physical labor, route robotic pickers, and autonomously reduce triage exceptions. And we've talked about Descartes acquiring AI to automate back-office data entry.
Right.
But let's look at the ultimate logical conclusion of the William Blair interface tax argument from our sources. The premise is that traditional software is essentially a tax on a human worker's time, the time spent clicking buttons, configuring rules, and reading dashboards. If the ultimate goal of true agentic AI is to completely and permanently remove that interface tax, meaning human workers never actually click a button, they never configure a routing rule, they never even look at a screen because the AI handles it all invisibly, what happens to the fundamental traditional SaaS business model?
That is the existential question.
When the software no longer has any human users at all, does the software company just become a silent, invisible intelligence layer running in the dark? And if so, how on earth do you price that? How do you sell user seats or licenses to a piece of software that essentially has no human chairs?
Risk defined, portfolio protected.
Risk defined, portfolio protected.